When it comes to investing, the fundamental question that we are asking when presented with a choice to buy or not to buy a stock is, what is this stock actually worth? If we think that the stock is worth more actually than what it's currently being shown as or sold at, then it's a good buy. But if we believe that the stock is too overpriced compared to what we believe it is actually worth, it is not a good buy. So, how do we then answer this question of what is a stock worth? Well, there's a number of ways to make this distinction and determination, but we will cover just one today, which is the concept of risk. Let's say we have a bet going for us, a bet of $5. So, we can bet $5, and 100% of the time, we get $5.5 back. Or, option B, we can bet $5 and 50% of the time we get $6 back, but 50% of the time we get $5 back. If you're like most people, you will pick option A. Why? Because even though the expected outcomes on average for these two options are exactly the same at $5.5, in option B, you are taking on a risk of perhaps not getting anything in order to get the same exact expected return, which for most people is not a good deal. So, most people have a natural intuition that we want to be paid for taking on risk. So, what is risk worth is the final follow-up question. Before we can get into what risk is worth, let's talk about what risk-free things are worth. We're going to be calling this risk-free rate of return RF. Let's say this risk-free rate of return is 2%. For example, the government bonds that are on offer, such as TIPS or T-bills, are what we consider risk-free. Although nothing in this world is truly free, for this example, it is the closest thing we can get to. So, if we have a government bond paying 2%, and we have a stock on offer, let's say stock A, that's returning also 2%. Why would we ever buy stock A? The return rate is the exact same, but the risk of stock A is much greater than that of the risk-free. We're calling beta F and beta A. So we have a single point of determination at this point of whether or not a stock is a good buy or not in terms of its risk factor. If the return of any stock is lower than the risk-free rate, then the stock generally is probably not a good buy. What about for stocks that are above the risk-free rate? What do we compare that to? Well, we would compare that to what everyone is investing in now, which is a market-based ETF, or let's say the S&P 500, what we're calling the market portfolio. So if the market portfolio is returning, let's say at 8%, and we have a stock that's returning at 8% as well, how do we know which to buy? Should we buy the ETF or should we buy the stock? Well, the determination in terms of risk is you would buy whichever one is less risky. Why? Because it's a more guaranteed way of making that 8%. If stock A has a return or a risk rate lower than the market, you would buy the stock A. But if the market has a lower risk than the stock A, then you would buy the market ETF. So now we have these 2 points, the risk-free, risk and return profiles, as well as the market return and risk profiles. With these 2 points, we can generate a nice line. So here we have a chart of the return and the risk. So the first line point we can draw is the risk-free. Obviously, risk is at 0, and it has some return we're arbitrarily calling 2%. Above it is the market rate with a risk we're calling beta M with an arbitrary return of 8%. So with these 2 points, we can draw a nice line. And this is the line that we will be using to determine whether or not an individual stock is worth buying. So let's go back to stock A. Stock A has a smaller risk than the market. And so how do we know it's a good buy? Well, let's consider a number of scenarios. Let's say that the risk or the return of stock A is at 1%. Well, because 1% is less than the risk-free rate, we would always just go with the risk-free option. But let's say that the risk or the return of stock A is at 3%. It is higher than the risk-free rate. So is it a buy? Well, no. It is under this line, and therefore we can say that at 3%, it's not worth buying. However, let's say that the return of stock A is actually at 7%. It is above this line, and therefore its risk-adjusted return is greater than that of the market. Therefore, at this return, A is a good risk to take. Let's continue along the same vein of a larger risk. So we have the same exact chart we had before with the risk-free and the market return with the market risk. But let's take a look at a stock that is even more risky than the general market, stock B. So we start out with the risk-free point and the market point. We draw that line. And again, we have the same exact scenarios that we're going to be taking a look at. If the return of stock B is, let's say, 1%, because it's lower than the 2% of the risk-free rate, we don't buy. If, however, the return of B, stock B, is at 7%, while previously for stock A, because it had such a low risk, it was a worthy buy as it was under this line. 7%, unfortunately, for a higher risk profile is under the market return rate, and therefore 7% is not a good return, and therefore B is not a good buy. However, if we take a look here and we have a return of, let's say, 12%, that is higher than this line, that means that stock B is a good purchase. So these are the factors that go into consideration when people are taking a look at the stock pricing. And so before you jump into any stock purchasing, take a look at what the risk rate is and what the return rate is. This, by the way, is what we call the CAPM model, where we are taking a look at the risk-adjusted rate of return and determining the value of a stock. Well, in any case, I hope this was helpful in your investment journey. And as always, for all your dividend investing needs, check out Div Income, available on Android and iOS.